Investing in emerging markets is one of the biggest opportunities of our lifetimes. 53% of the world's growth over the next 10 years will occur between Africa and India. Our companies have raised 8 times the amount of money in follow-on capital that we put into them. We've also mobilized double the amount directly of our fund size in additional capital, and we have an 87% net promoter score, meaning that our founders are highly likely to refer us to other founders. And we do give a percentage of the profit share of all of our venture funds to the founders in the portfolio as well.
Hey everyone, this is Prashant and I'll be host for the VC 10X podcast, and today we have Eva Yazhari with us. Eva is the founder of Beyond Capital Ventures, who argues that high risk, high return philosophy we all take for granted is actually a myth. She has taken her Wall Street hedge fund background and built a VC firm focused on emerging markets in India and East Africa, and believes the portfolio is actually less risky than Silicon Valley VCs. We'll dive deep into what she calls conscious leadership, why emerging markets represent one of the biggest opportunities of a lifetime, and a completely unique approach of sharing carry with the founders in a portfolio. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help venture capitalists, asset managers, allocators, and family offices in starting their own podcast and building a strong brand. Podcast 10X is designed in a way to work well with the busy schedule of investors, where we handle every aspect of podcast production so you can focus on investing. If you're looking to build a strong investor brand, starting a podcast should be right up your priority list. It's the only form of marketing where you can showcase your strong network, in other words, access to limited partners and founders, and grow that network further. And contrary to what most people hear, it's still very early to start a podcast. There are at least 10x more newsletters and 1000x more blogs than there are podcasts in this world. You can learn more about our podcasting services at podcast10x.com. I'll make sure to add the link in the description below. Enjoy this episode. Hey Eva, so good to have you on the VC 10x podcast. How are you doing?
I'm doing well, Prashant. So good to be here with you today.
Yeah, it's a pleasure having you on. To start things off, can we first have your story and your journey from managing hedge fund investments to now launching Beyond Capital Ventures? What inspired you to focus on conscious investing and emerging markets?
Absolutely. So I grew up in New York City. I am American, but my father grew up in Tanzania. And when I thought about what I wanted to do with my career, I was actually initially a mathematician. I have a degree in math, and then ended up working on Wall Street. I worked in the fund of hedge funds business, but it was a very unique time. It was actually during the great financial crisis. I was investing in Wall Street's top hedge funds. Many of them actually did quite well or, didn't actually perform poorly during that time. But the skills that I had acquired were deep due diligence, portfolio management, portfolio construction, and knowing how to run a fund business and scale a fund business. And because of my upbringing, when the great financial crisis happened and Lehman went bankrupt, I decided simply to think a little differently about how to use those skills, and thought a lot about the opportunity to invest in maybe what a hedge fund manager would call a contrarian bet. A bet that was very different than what others were doing. And that was betting on the future of global growth. It was betting on the future of the global consumer who actually is lacking access to need to haves. And that's what we invest in at Beyond Capital Ventures. So that was kind of my pivot. Not as easy as it sounds, but that was, the thinking behind moving into very, very different markets and even a very different asset class.
Absolutely. Yeah, that's quite interesting. What were the biggest challenges you faced in this transition from traditional finance to impact focused venture capital, and also the key learnings or maybe surprises that you found along the way?
Yeah, well, I never felt that the transition from traditional finance to impact needed to there needed to be any sort of giving up of specific skills or any sort of, let's say, rigor in the due diligence process. I always came to the table with this same mindset that I would have when allocating hundreds of millions of dollars to hedge funds. And because of that, I think I've actually been quite successful. So, we have a mantra at Beyond Capital Ventures: "No money, no mission," and that mantra is really important because a company actually can't have impact if it's not sustainable. And I thought, what is more of a beautiful tool than capitalism to create change, whether it's social change or environmental change, and support growth in areas that we need as a human race. And therefore, the pivot wasn't that complicated because I just ported over my traditional finance skills. However, I was in public markets largely. The hedge funds we were investing in were trading in equities, in bonds. There were a few private investments, but they were not a large component of their strategies. And so, what I did, like anybody who's moving into a new field, is I sought out mentorship. And I had a number of mentors, not only prior VCs or individuals who had worked in the VC ecosystem, but also angel investors who taught me about, the nuance of doing a deal, not just, there's a safe note and here's the cap and potentially there's a discount. Really, what happens when you get to the table and you don't agree with a founder and you still want to invest in their company? How do you get that deal done? So I learned that firsthand from a number of people. And I would say my lessons learned were really to believe that there doesn't need to be a trade-off when thinking about impact, because wherever we place our effort, that's where the results ultimately come. And we have been able to generate top quintile returns in our first fund. But the second was to not think of impact as secondary or as, kind of a younger stepchild or, something that wasn't necessarily valuable. It was to use the tools and the information that impact gave me in order to make better decisions. And that is why I think we have become a preferred venture capital firm on investors' cap table, on companies' cap tables, because we have a deeper awareness of what businesses actually achieve.
Absolutely. Yeah, quite interesting. And you've called the high risk, high return philosophy a myth, right? Can you
Mhm.
unpack this for us?
Absolutely. I mean, so I'm an American and I live between London and Los Angeles, and I'm in India twice a year. I'm in Delhi twice a year. And I'm in Africa twice a year, and we have local teams in India and Africa. So that's kind of like the context by which I come to this conversation. So I do spend most of my time when I'm not traveling in the state of California. So like the home of Silicon Valley VC. And here's the deal. Risk is in the definition of the investor. And this is why high risk, high return is a myth. I believe that from my 14 years of investing in emerging markets, which we haven't defined yet, but those are East Africa and India, and having incredible portfolio companies, that my portfolio actually has less risk than Silicon Valley VC. I get the opportunity to do more due diligence. I have a framework around getting to know founders. We call that conscious leadership, understanding leaders for who they are. Are they abundance mindset? Do they see possibility? Are they not just leaders? Are they also listeners? And are they in love with the problem and not just the solution? Whereas a lot of VCs, even the best ones, often are given a term sheet, told what the valuation is, a few details about the business, and have to decide right there because otherwise that company will move on to to their competitor. And so risk is really, I think our view of risk is skewed. People believe that emerging markets are too risky when investing in healthcare, financial services, mobility, agriculture, those are the areas that we invest in, all tech enabled businesses. Can be steady investment returns, and many investments that we make, we kind of model them between 5 and 8x across the spectrum. We're not looking for a, portfolio approach where businesses, all of them fail and a few are 10 to 100x. So I think that's a much more risky game, and therefore, the perception of risk is incorrect. And our willingness to think about what type of return comes along with that also needs to be adjusted.
Absolutely. Yeah, that's quite interesting. And when you're making these investments at the very early stages of a business, what are the key things that you're looking for? How you diligencing the deal, like you said? Give us a look into that.
Yeah. Well, I mean, of course, we have a very traditional VC process in the sense of market, model, even company mission. Like, what are they looking to achieve? What's their big vision? Who's the management team? What are the metrics that they're tracking? You can see these are all M's because we have a number of frameworks within Beyond Capital Ventures. So his business always has to be post revenue for us. We don't just meet the founder, see the tech, write the check on a piece of paper business plan. There needs to be some element of product market fit as well. We also invest in companies that are typically, we have some criteria around all businesses being based locally where we invest. It can't be a company run from afar. That just doesn't work. But what we really are looking for are leaders who believe in evaluating the needs of all stakeholders. And that is how we bake impact into business models that are sustainable, profitable, and business models that we believe will grow and scale and produce venture capital um, style exits such as IPOs or secondary sales or be acquired by strategics. And 57% of our portfolio companies in our last fund have exit pathways built into the businesses, whether it's through partners or through those investors actually already being on the cap table. So that's also something that we look for upfront because one of our other mantras at Beyond Capital Ventures is that exits start on day one.
That's quite interesting. Yeah, there's sort of a divided opinion on that. That should VCs, especially investing at the earlier stages, be looking at the exit potential because you really don't know much about the business at that stage. There can be pivots and so many other things that can happen. How do you look at that? What's your perspective or what's your lens at evaluating for exits? Do you want clear founders to have a clear mindset? They want to optimize for exits. Let's say the founders don't want to optimize for that. That can be a scenario as well. They want to go build for the long haul and maybe turn down exit options if they're not lucrative enough as well, right? So you also have like, okay, when you're signing the agreement that I should also have a say when there's an exit option on the table, would you exit or not, right? So give me a look into that.
Sure. Number one, I think we are try to aim to be conscious leaders ourselves and be listeners. And what we really want to hear is an explanation that there is a view towards an exit. We would not invest in a business that is intended to be an SME or a family business run into the future. That is not why we are in the business of managing people's money. And I explain that over and over to our portfolio companies, sometimes even when they're already in the portfolio, not necessarily around exits, but that like we run a business too. And our job is to produce exits and returns for our LPs. And so exits do start on day one. And when we do our portfolio modeling, we define the specific route through which we do believe an exit will happen. We also define a particular value at which we think that exit will occur. And we look at the entire portfolio, and this is part of the portfolio construction conversation, and decide whether this company fits into our portfolio from that perspective. Let's say that we have, too many businesses that, we think are potentially more moonshots. We may not add another. We may add a more stable business that we know will, disrupt an industry and be acquired by an incumbent in that industry, and it's pretty obvious that that's going to happen. And we like companies like that. So there are logical ways, I think, to think about exits. Again, already having strategics on cap tables or as partners in the company, investing in sectors with, what we call kind of formalizing the informal, sectors where there's a little bit less of tech or kind of a scale in those industries, or frankly not a product available. We just are adding one of those to Fund 3 in India that I'm happy to talk about. And therefore, I think all of these qualities really add up to exits being possible. And then finally, yes, we do talk to founders about exits in our major when we lead rounds, and we lead the majority of our rounds at Beyond Capital Ventures. We have major investor status, and in having major investor status, we do have say over when and where exits come from. We also have promoter buybacks in India, to be able to protect us in the event that something does change. Now, the reality is things always change. That I know as an investor. And so then it's our job to help navigate how things change. So if a company is not meeting their revenue targets, to be able to attract a strategic, are they meeting their revenue targets to grow and potentially list their business, or even allow us to have a secondary sale? And the final thing I'll say is our very strong relationships with our portfolio companies lend to secondary sales, and we have had multiple of those in our track record that have created exits for us. So we kind of are aware of what the options are. We model it out, and then finally we rely on strong relationships as well as internal strategy to be able to drive towards the right exits, for each portfolio company, hand in hand with those founders.
Right. Got it. Quite interesting. And while you're investing in markets like India, East Africa, how do you look at those markets in general? At what stage do you think they are in the journey? And what are the interesting, opportunity areas that you're carefully tracking in these areas?
Yeah. The biggest, I think investing in emerging markets is one of the biggest opportunities of our lifetimes. I'll state that I also think venture capital as well as artificial intelligence are two others that fall into that category, but EM is one of the three. And the reason is 53% of the world's growth over the next 10 years will occur between Africa and India. We also know India has the world's largest working age population, and something called long tail India, which is kind of the potentially off the outside of the kind of commercialized part of the country that can grow their incomes and demand access to need to haves as well. And that's why we focus on need to haves, because the demographic dividend and the demographic tailwinds really support the kind of growth of healthcare, financial services, climate for us, but we break that down into mobility and agriculture. And those are the areas that we are really watching. I have, been in this market long enough. I've been an investor in emerging markets for 14 years to see some of the trends create bubbles. One of them is that, it doesn't matter what sector it is, but anything tech is, should be invested in, and valuations get really high. There's obviously a wave of potential, some people taking money off the table, and then there are the bubble bursts. We are very careful about the inclusion of tech into our portfolio companies, depending on where they are based. In Africa, really businesses need to have more of a tech-enabled approach rather than a end-to-end tech solution. In India, end-to-end tech is definitely possible, but we're still very cautious about, investing in only one type of company. We have a very, beautifully diversified and intentionally diversified portfolio to be able to produce the returns that we have also promised our investors.
Got it. Yes, and these companies can be locally registered as well. They don't need to be registered maybe as C corps, right? Is that correct?
Yeah. So actually, our investment strategy includes African businesses registered as C corps mostly. That is typically the norm to create your holdco off the continent. Whereas in India, we invest directly into businesses that are based within India and registered.
Got it. Yeah, thanks for sharing that. And how do you identify these founders and startups that truly align with your values of conscious leadership and impact?
Yeah. Well, we have team members in Bombay, in Delhi, and in Bangalore. And as what our senior investment associate recently said, India's a big country, but a lot of the startup activity really occurs within a small group of VCs, a small group of people between Bombay, Delhi, and Bangalore. And so, um, while I love many parts of the country, I am typically only in those cities when I'm spending time with founders. We do have companies that have expanded across the entire country, but we are looking for our deal flow in those ecosystems. Now, when it comes to impact, we we view impact uniquely. It doesn't again, it's not a concessionary bet. And so sometimes the accelerators that are focused on impact are producing a little bit too much of a skew towards impact first. We are looking for this perfect blend of impact baked into a business model. And therefore, we have our own assessment. And that is really the conscious leadership framework. And in our screening, just for your knowledge, we have a below 2% selection rate on our all-time deal flow. So the funnel's very wide at the top. We narrow it down to, um, you know, not many businesses. In Fund 2, we made 15 unique investments, and 6 of them were in India, and 9 of them were in Africa. But when we filter in our process, we are asking questions about leaders who are thinking about all stakeholders. Are they behaving above the line or below the line? Do they see possibility, or are they more kind of short-sighted and scarcity mindset? We screen for this, and this is how we get to the heart of impact. Of course, their business should be impactful, but we often find that conscious leaders are creating impactful companies, and that's a project that I did. You may know that I have two podcasts. One is called the Beyond Capital podcast, and the Beyond Capital podcast was effectively a research project where I interviewed over 100 purpose-driven leaders to assess what drove their purpose. And what it really was awareness of all stakeholders.
Absolutely, yeah, completely agree on that. And uh, what does it mean to be a preferred investor, right, in today's competitive venture landscape? And what advice do you have for investors looking to build a stronger relationships with founders?
Yeah. Um, I think there are a few really key ingredients to being a preferred investor on cap tables. But I'll tell you the secret for us at Beyond Capital Ventures is really that where where we get our most goodwill with our portfolio companies stems from the Beyond Capital support that we put into them. It stems from what's called GP value add. The Whether it's calls we're willing to take day in and day out, the advice we're willing to give, the financial modeling assistance that we can support them with, the business model pivots that we can help them think through, the marketing plans that we can review, the introductions to founders. And we have a lot of metrics around this. Our companies have raised 8 times the amount of money in follow on capital that we put into them. We've also mobilized double the amount directly of our fund size in additional capital, and we have an 87% net promoter score, meaning that our founders are highly likely to refer us to other founders. And let's be honest, we're not always the largest check, but here's the deal: I know the language of I give you the money, and you do what I say. That's a Wall Street old school tactic. There's nothing interesting about that anymore. Like that, if you want that, just go invest in a hedge fund. A lot of hedge funds are relational, but a lot of them also still operate with this very kind of specific framework of I provide the money and you take all the terms that I give you. And the reality is that just creates financial crisis after financial crisis, whether it's blow ups like Madoff or FTX, or, this great credit default swap trades that leave people holding the bag, including the banks, the government, and the taxpayers in America. And so what we're trying to do is really create new ways of building capital markets, and then creating new ways of building capital markets. The relational and the supportive approach earns a lot of credibility. And that's why we've been able to become a preferred investor. Now, Prashant, there are other ways. We also have a credit fund. So we are a multi-strategy firm. So we are able to provide debt to our portfolio companies when they need it for working capital quickly. And our underwriting is relatively straightforward. And then we do give a percentage of the profit share of all of our venture funds to the founders in the portfolio as well.
Yeah, yeah, that's a quite unique approach there. And now talking about the abundance mindset, which you talk about, right, and the need to shift from scarcity mindset to abundance mindset. How do you look at that play out in your maybe your portfolio, or an example you can give of what it means to have abundance mindset in practice?
I believe that for some reason, capitalism has been become synonymous with when I win, you lose, and that this is a zero sum game, and that there can't be a win win. And I never really understood that. Um, the reality is, win wins are all over the place. A company needs capital, an investor can provide that capital, and that capital can then help them produce results. And the management team does well, the customers are happy, the employees are happy, etc. And so that's what the definition of abundance is. It's understanding that the pie is not finite. And the thinking, and this is, scientifically proven, that the pie is finite, aka scarcity mindset, is limiting. And I mean, I grew up in the Bombay of America in New York City, and there's no limiting beliefs there. It's all about possibility. And that's why I believe so strongly that the abundance mindset is really important, because why would I want to limit my investment strategy? Of course, we have our parameters. Of course, we have criteria. That's called boundaries, and that's called having a strategy. But to limit my thinking around what's possible, I think limits my business. And you see, as I mentioned, we go above and beyond in terms of how we work with founders. We give them a share of our profit. It is money out of my pocket. We also, kind of support them with introductions. We don't really have to do any of this, but we do it because the relational approach yields much stronger results for company and for the investor.
Absolutely. And you mentioned about giving money out of your pocket, and I've also learned you share carry with founders. So give us a view into that. What does that look like?
Yeah. It's pretty simple. I was several years ago, mid pandemic, in my home in Los Angeles, listening to a podcast of a UK based VC. And that VC simply wanted to create a fifth partner. They had four general partners, and they wanted to create a fifth. And they decided to give 20% of their carry to all the founders in their portfolio to create this kind of community of their fifth partner. And it made so much sense to me, not only as an investor who invests primarily American money. We have, of course, some European LPs and some African LPs, but because of our fund structure, not so many Indian LPs, although very happy to talk to them. Um, so taking money out from outside of where we invest, primarily investing it, and then returning capital plus returns, it felt also more like a win-win to be able to give the founders who are doing the hard work some element of our profit share back so that they can share in the profit of the other companies in the portfolio. And it's created a glue amongst our founders that where they actually want to support one another. They actually want to connect, understand each other's challenges, and potentially even work together in the future. And that I think has really helped the success and the resilience of what we built. So it's pretty much a no-brainer. I mean, when you carve out 10%, companies do have to meet specific milestones. There are, ways that they earn this carry, but at the end of the day, they just get their distributions like any other recipient of GP carry as well.
Yeah. Yeah, that's quite interesting there. Yeah. So talking about your portfolio, would you like to mention some interesting companies that you back that are solving important problems?
Yeah. It's really hard to pick favorites. I'll run down a quick list. We're invested in Fossil. Fossil's a IoT device for horticulture farmers. It's basically a digital scarecrow, expanding within the country in India as well as in Southeast Asia and potentially Africa. Great business, incredible founders, very thoughtful, and frankly, I think one of the first ag techs that has been able to grow and scale, um, kind of almost generation two and learn from those in the past. We're also investing in Clinic, which is a brick and mortar health chain, but also has a very innovative approach to offering insurance for for inpatient for their patients who, have more serious needs. They also have a subscription model, and their whole market segment is really focused on the aspirational Indian who doesn't have access to either private, higher end private doctors or higher end public hospitals, who don't have the connections to get the healthcare that they really need and make that healthcare affordable and quality. And then we are also invested in Alt Mobility. It's an EV leasing platform. The company helps to maintain fleets, but also lease fleets. And this is mostly two wheelers and three wheelers in the Indian ecosystem. And it's a number of second time founders who are very dedicated to the climate space. So those are three great examples in India in our portfolio, but the list goes on a little bit more than that.
Yeah, absolutely. Yeah, thanks for sharing that. And coming to our last main question before we move to the rapid fire round,
Mhm.
this is what's been your biggest learning investing in startups over the years?
Yeah. Well, I think one thing I've learned is that the relational approach always succeeds, good and bad. I mean, let's be honest. I said things change. Being an investor is you have to love the journey of being an investor because not every day is what you want it to be. It's A, running a fund is operationally complex. B, raising money is also not just not easy for anybody. Um, and C, uh, companies do have ups and downs and need some serious support over time. And you basically have a portfolio of, for us, 16 of them, and for many VCs, it's much more than that. Um, I think my biggest learning is really, leaning into relationships, supporting founders where they're not. I didn't mention, but in addition to some of the other GP value add, our founders have a trust circle where they can talk to other founders in the portfolio in their region confidentially without Beyond Capital Ventures input. And that glue goes the extra mile, for sure. And that is also a relational approach. So believe it or not, we can do all the analysis that we want. And of course, we won't stop doing that. But if we don't engage in the way that founders are, needing more support, will be no better than our competitors, no better than any other VC. And I really do believe our secret sauce is in our ability to support in a meaningful way and know the nuance, the deep nuance of what our portfolio companies actually need, which is why we can also operate with a lean team. We don't need a team of former investment bankers. Our companies are smart enough to have a lot of those skill sets. Of course, if we need that, we can hire it out. We need a team that is trained in conscious leadership so that we can steward the future conscious leaders in the markets where we invest.
Absolutely. Yeah. Great approach there. With that, we come to the rapid fire round, and we have 6 questions for you you'll need to give quick answers to, right? So the first one goes, what are the sectors and regions you invest in?
India and Africa, and sectors healthcare, financial services, mobility, and agriculture.
Got it. What's the typical stage you invest in?
Seed to Series A plus, sometimes a little bit of Series B with good pricing.
Got it. Do you lead rounds?
Yes.
What's the typical check size you put in?
In our last fund, which is a little smaller, we started around 500,000 to 1,000,000. In the fund three, we started out with 500,000. We'll be moving up to 200, 2.5 as well in some later stage rounds or follow-ups.
Got it. Where can founders get in touch if there's a direct way?
LinkedIn's always great. Go to the contact page on our website. There's a form to fill out for deal flow. And you can follow me on Instagram at Conscious Investor.
That's great. Uh, Last one is where can listeners follow you? I guess it's the same Instagram and LinkedIn.
Sure.
All right. Yeah. So I'll make sure to put these links in the show notes below so our listeners can get there easily. Thanks so much for taking the time for doing this episode, Eva. And I wish you happy investing.
Thank you. It was a pleasure. Thanks for
Bye.
hosting the show.
Likewise. Thank you.